We're looking at Mphasis now. Revenue and profit beat estimates and margins have seen a slight expansion. My colleague Samina caught up with the management who talks about the quarter gone by. Listen in.
The short answer is definitely the peaking of the cycle was visible for the last, I would say, 3 quarters or so. We actually called for bottoming in our banking and our mortgage business back in December timeframe. It's been a slow but certain recovery from there onwards. We've seen definitely a slight uptick in budget conversations, in spend conversations, in actual deal making. Short burst duration deals picked up earlier in the year. We've seen some of that play out in this quarter as well. Conversion from sold business, the order book, into revenue has also actually improved a little bit more this quarter, as it has been over the last 2 or 3 quarters. So from that perspective, definitely the direction of travel has been, in the right sense. But the pace is still a little bit uncertain because, as I was mentioning to you, there is a lot happening in the macro and the geopolitical world. And until we get clarity on a few more variables, I think we'll continue to see caution in committing to large programs. And if that wasn't enough, there's obviously a lot of excitement and confusion around what AI means to enterprises and how best they can adopt it. And that also creates a little bit more of a elongation in the decision cycle. So I think it's been a very execution-oriented quarter for us. We've just been very focused on executing to order book, executing to individual client needs, priorities, propositions within verticals, within geographies. And from that perspective, pretty pleased with the outcome of the quarter.
Nitin, your deal pipeline has been at a record high now for quite some time, right? Engagements have also been signed. But I think one thing is putting pen to paper and the other is actually that converting it to revenue. Are you seeing an uptick on this in the quarter that's gone by? And we usually like to talk about an outlook over a 12-month period, but because things are changing so swiftly on one hand and predicting things is so much tougher, let's talk about what happened in the last 3 months and what are you seeing going ahead? An uptick in conversion is visible, or is that still very slow?
So I think if you look at the way the funnel gets built, you obviously have opportunities that turn into deals in the pipeline. Then you convert that pipeline into TCV by actually signing some deals and committing clients to a program. And then from that point on, you start converting the TCV into revenue by actually executing on the programs. I think the pace of deal making, or at least origination of deals, has been pretty robust the last few quarters. Same case in Q2. Conversion from pipeline to TCV, I would say, still a little bit stressed because clients are still cautious in committing to large programs. But they are definitely looking at executing programs that give them immediate ROI. So there is an uptick in small deal volume. There's an uptick in immediate conversion. I need to get this program done in the next 6 months, and let's execute it. And then, of course, conversion from sold deals to revenue has actually definitely picked up. And that's why we've seen an uptick in revenue, especially in BFS coming through, which is mostly executing the deals that were sold in the previous few quarters. So again, in general, improvement, but conversion into actual commitment of deals still a little bit slower than we would like it to be. We've also seen another trend, especially in Q1, especially in, I would say, Q2, where there is an emergence of a category of deals where clients are now actually being curious about, can you infuse AI into my IT operation? And hence, can I see 30-40% cost takeout and productivity gain? And if that's the case, then I may have to look at how I spend the dollars and where the allocation of my budget will be for 2025. So early stages for that, but it's an interesting sign. We've been expecting for this to pick up. We call it an AI ops-led deal. I think those will actually open up the pipeline a lot more because there's certainty of outcome and ROI in those deals.
We'll talk about that in a minute, but you did allude to the fact that it's the small deals, it's the quick engagements, right? So one-off deals that come in where you spend some time, elevate the client if that's what they need, and you move on. Now, that is great, but it's not really sticky business in that sense, right? Would it be a fair sort of question for me to ask you to split this up on your deal pipeline, of course? What is the split? How much of it is coming in from long-term deals and engagements, and how much of your top line has come in from those one-off small engagements that you've undertaken? Arvind, you can take that one.
No, so I think, two elements to it, right? I think there is always a run rate of deals in the, I would say broadly classify as maybe 0 to 1 million or 1 to 5 million kind of pipeline, and that is typically much shorter cycle, and that's always kind of remained constant. I think a lot more volatility in the funnel happens when you look at large deals greater than 20 million, and that's where Nitin was alluding to in terms of their own cycles coming in. So it's difficult to kind of quantify in terms of what proportion comes in, but I don't think that proportion has changed too much, right? I think that run rate has largely remained what it has been historically. And the deltas in TCV wins happens due to, some of these large deals tends to make it a little more lumpy and volatile.
Right. Also, let's talk about, of course, we'll talk about AI and the geographies, but a few more, sense that I want to understand is, I know in July you talked about that you would be able to very comfortably manage margins above 15, and you've successfully done it. I think you've done 15.4, 15.6 in this quarter. How is that happening? Are these shorter tenure deals better margins? Is that why the margin profile has improved? Has the product mix changed? Are the clients that have come on board willing to pay more? Please explain this to me, Arvind, because in a tough environment, you only have that much bargaining power, I would imagine.
No, I would say, we've improved our margins by about 40 basis points to 15.4. We delivered 15% last quarter. They improved by 40 basis points. I would say about 20 basis points is due to Forex and 20 basis points is due to various operational efficiencies.